Hello, I'm Brian Resnick. I'm a senior investment strategist with AllianceBernstein, and welcome to Uncommon Capital, a podcast where we explore the far corners of the private markets and learn important lessons from professional investors. I'm thrilled to talk to today's guest, Matt Bass, who is head of private alternatives at AllianceBernstein. In his role, he leads the strategic growth and overall management of AB's private alternatives business, which spans the firm's private credit, real estate, and other private market investment strategies. Matt began his career in investment banking and private markets investing, but interestingly, left the private sector to join the Department of Treasury, where he helped design and implement real estate and capital market programs under the Troubled Asset Relief Program, better known as TARP. Matt's diverse background across government, investing, and business leadership gives him a unique perspective on private markets, and I'm really looking forward to speaking with him today. So, Matt, one of the things I find most interesting about your career is that you started off in investment banking and in an investment role, and you shifted over to the public sector to go work for Treasury. What was behind the thinking? What made you make that shift?
Sure. Yeah. So this was 2009, time we all remember for sure. I was about 9 years into my career, and a colleague of mine at the time at Blackstone announced to the firm that he was leaving to go work in domestic finance, the Treasury Department. So I had a background in financial institutions. I'd done that on the banking side. Was obviously interested in what was happening. I reached out to that individual, and that initial call led to another call, led to a meeting, and the next thing I knew, I was packing up and moving to D.C. So we didn't have kids at the time, so it was early. I was able to take that risk, but it was an opportunity that was really attractive, probably too good to pass up at the time.
Yeah, and so, this is amazing. We're in the heart of the financial crisis. Practitioners in our market were uncertain of where things were going to go. Certainly policymakers were scrambling. Tell me a little bit about that experience. seeing the financial crisis from that lens, what did it teach you about markets and sort of where things had evolved from there?
Yeah, stepping back, I guess, there are kind of three things I learned that I took with me. First is when regulations change, market structure changes. So, what I saw, what I had a front row seat to was the really re-regulation of the financial system, and the view that I held that a lot of the bank lending that happened within banks was going to move outside the regulated financial system. Two, it has to do with risk, and that's not just about the asset risk. It goes way beyond that. So it's liquidity, leverage. Often what looks like a asset risk is being driven by leverage, liquidity, being a forced seller. Three is really anchored in thinking in terms of first principles. So at Treasury, we encountered a lot of problems, and the approach was always, what is the right thing to do from a policy perspective, from a financial perspective, and then how do we navigate that decision, as opposed to the opposite.
And it's funny because you say the asset versus things like leverage and liquidity, and I feel like, and we're going to dig into this more later in the conversation, but nowadays there's a lot of questions around private markets, and that is interesting that I guess what I'm taking away is you're saying that the underlying investment could be a very sound investment, but the way the market or a manager or an investor applies leverage or interprets liquidity in the market as being risk, it's different than the underlying original investment being a good investment. Is that what you're saying?
Absolutely. Often what is leverage or liquidity risk is disguised as asset risk.
Very interesting. Yeah, so let's talk about that a little bit. I guess to take a step back in terms of the private markets, as you were thinking about, you're very involved in building the business at AB. And I'd love to, know, what were some of the early lessons that you learned as you're sort of building this private markets business at AB?
Yeah, so the business today, it's about $80 billion across private market strategies, largely grounded in private credit. So we built this really over the past 15 years, largely from scratch. It was a natural extension of our existing public credit business. That's part of the firm's DNA. So it was a very natural place to start. We were led by client needs. So if those are insurance clients looking for incremental yield, or private wealth clients looking for diversification, that was the North Star. And it was a very kind of focused and deliberate build out. We did that through team lift outs, team build outs, acquisitions. Most recently, 3 years ago, acquired AB Carval that really completed the platform. It was a very thoughtful build, focused on credit.
You mentioned that this heritage and credit being applicable across public and private markets. Do you see them as being distinct, or do you see similarities across public and private credit underwriting? As you think about building out this sort of private markets business, you talked about having this heritage within public credit and the similarities. What do you think the balance is between sort of letting some of these teams continue to do what they've done versus integrating them into the broader firm? How have you navigated that as an asset manager?
It's really a combination. So first, what we want to preserve is the team focus, their investment process, tried and true, that's been tested. We don't want to change that. We want to preserve that. That's critical. In addition, we want to preserve the entrepreneurial drive and focus that you have as being part of a focused investment team. We also want to preserve the alignment that creates. So investment process, entrepreneurial focus, alignment, we're going to keep those. We want to then wrap those teams with what we have as a broader organization.
And you mentioned some of these semi-liquid vehicles, and that kind of brings me to the next part of the conversation, which is as private credit broadly, or private markets broadly, and private credit specifically seem to make their way down into the wealth channel. We're seeing a lot of capitulation these days in terms of fears or perhaps misunderstandings around the market. What do you think investors misunderstand the most or get wrong when it comes to approaching private credit these days?
Yeah, a couple things. One, private credit is not monolithic, right? So even within, you could take corporate direct lending as an example, the largest, most established part of the private credit market. Even in corporate direct lending, I look at our business as an example. We lead or co-lead about 90% of the deals in our core direct lending strategy. There's not a lot of overlap. We're generally, in those cases, the only lender or a group of small like-minded lenders. So there's not a lot of overlap across even corporate private credit managers. Then I would say, we're seeing significant growth beyond corporate private credit. We've seen this for a while in asset-based finance, if it's commercial mortgages, if it's consumer, if it's hard assets. Those markets are probably an order of magnitude larger than the corporate private credit market, very different in terms of the underlying risk profile of those assets. And I think we're starting to see, entering an environment where we're seeing more dispersion, not less. We're seeing fundamentals moderate, liquidity pull back. And when that happens, you're going to see more dispersion across managers. So I think the differences between managers is going to be probably more pronounced going forward than it was historically as well from a private credit perspective.
What do you make of these negative headlines? Do you think it's a real signal that there's a problem with the market or with elements of the market? Or do you think it's noise or maybe somewhere in between?
So look, stepping back, our market, private markets, there's not as much transparency in our space relative to public markets, for sure. Now, a lot of that is by design. It's not a flaw. And in the absence of daily transparency into everything we're doing, headlines fill the gap. What we're seeing is more moderation of fundamentals and moderation of liquidity. And this industry has taken in a lot of capital. There have been a lot of new entrants. There's been a lot of capital deployment. A lot of what we're seeing is moderating of those fundamentals of that liquidity as opposed to anything systemic in nature, right? As I look across the market, as I look across our portfolios, now there have been some isolated high-profile incidents, but we don't view that as being systemic. We view that as being cyclical normalization.
Do you think some of these newer disciplines have lost underwriting discipline, or is that something you fear, or is that something that's idiosyncratic to your point and manager to manager as opposed to systemically across the business?
Yeah, my view is that what we've seen has been largely idiosyncratic so far. But you have to look back. There's been a significant amount of capital raised, not just in private credit and credit strategies broadly. When that happens, that capital needs to get put to work, and manager discipline gets tested. So I think what we're seeing now is part of any normal credit cycle. With the normalization in fundamentals and liquidity, you're going to start to see more dispersion and differentiation between managers. This is not systemic. This is normal cyclical behavior we see in credit.
So we talk a lot about the negative headlines, and clearly, to your point earlier, some of the headlines are filling in for maybe the opacity that naturally exists in private markets. But it does seem like one of the areas that's particularly in the crosshairs of the news media these days is software as a service. And so I want to get your thoughts on whether there's really a crisis as a result of AI in that sector, or if it's a more nuanced story.
AI is a risk and it's an opportunity. And I think as it relates to software, you got to really assess it company by company, right? In some cases, they're headwinds. In some cases, they're tailwinds. Let's talk about some potential positives. Well-run software companies are already introducing AI-enabled product enhancements on the front end, right, to increase the stickiness and the value add of their product. You've got AI facilitating faster R&D and development cycles, compressing the cost of development. You've got AI supporting automation and operating leverage at these businesses, just like we're seeing across many businesses, right? Now, on the risk side, you certainly have the risk of more competition from AI native entrants. You've got also the risk of commoditization. So commoditization of really lower value applications, which gets to, when you think about AI risk and software, you gotta think about it in the context of the underlying business and the solution they're providing. You also have some software businesses that are probably more exposed, right? So think lower value add applications that AI can replicate more easily. So categories like dashboards, lead generation tools. These applications sit on top of what I earlier described, a vertical application, right? So it is going to be very, very company specific.
Yeah, and that's a great point. I want to dig into that a little bit more because at the end of the day, when folks hear about a threat to growth in a particular business, they often think of an equity investment. But as a credit underwriter, you're in a very different position. So talk a little bit more about that credit underwriting and some of the protections that you think about as a private credit underwriter.
Private credit, if used correctly, is a terrific risk mitigation tool, right? So starting with your funnel. So asset selection matters. As a private lender, you're going to be able to see opportunities, right, outside of the public market. You could be very discerning in terms of what you pass on and what you truly look to focus on, right? That's going to be based on where you have a particular industry edge, in addition to company fundamentals. So one would be asset selection. Two would be the ability to lead a transaction, structure, and drive documentation. So this is an important part of the investment as well, where you can embed covenants, controls that give you a seat at the table, should there be issues with the company fundamentally. Third would be active management. So when a transaction closes, monitoring that deal actively, trying to see ahead the next 12 to 18 months, are there any issues around the corner, so you can get ahead of that, proactively engage with the sponsor. So those are three tools in terms of asset selection, structure and deal documentation, and active management. And the active management is really driven by the fact that in most cases, we are the only lender or in a small group of like-minded lenders. Those three elements really allow you to drive and protect to the downside.
Right, and so I'm here's one of the unique things about being a private credit underwriter in particular is the ability to impact the outcome, whether it's the company to support the company so they have more success, or to have covenants, as you would say, to get more control and perhaps more recovery out of a default if it should happen.
It's active asset management to an extreme. So if you are investing in a broadly syndicated loan, if you have a relatively small diversified position, if something goes wrong, you could sell, right? If you didn't make the right credit decision on the front end, you could sell. As a private investor, you have the ability to structure covenants, monitor that business, and get ahead of potential issues constructively.
Well, what do you think about liquidity in the markets? Because it does seem like we've seen some large deals change hands as we've seen liquidity events and firms try to exit positions pretty easily, right?
what we're seeing is a maturation of private markets, so private credit specifically, growth of corporate direct lending, growth of asset-based finance. As the market has grown, you've seen more institutional, retail, insurance participation. There's a lot of depth. And as that market matures and grows, it's only natural for there to be more secondary solutions, right? So I think, that is a function of the market maturing. That's a function of the interest in the asset class.
Yeah, and you mentioned as it grows to areas like the wealth channel, and we've seen some controversy around these semi-liquid structures. How do you think investors should think about, liquidity expectations in the context of even these semi-liquid structures?
Yeah. So first of all, stepping back on the structure, I'm very pro semi-liquid vehicles and the ability to deliver private credit to individual investors more broadly. Very pro that. Very against the notion of delivering any sort of liquidity that's not aligned with the underlying assets, right? So you got to separate the two. Irrespective of the wrapper we introduce, the underlying is the same. It's illiquid. So for me, I think expectations need to be managed appropriately.
Right. So it's almost like if you want the benefits of private markets, there's no free lunch. And it does seem like, more retail investors are starting to recognize that you have to get comfortable with giving up liquidity to participate in illiquid markets, which sounds obvious, but it doesn't always feel good when folks are not as accustomed to it.
Yeah, it gets to education, becoming more accustomed to it, and also how you size it, your overall portfolio. So if you're looking at the public non-traded BDC structure, the interval fund structure with 5% tenders on a quarterly basis in each as a market standard, you're looking at a 3 to 5 year weighted average life of an investment, just looking at the underlying and looking at the cash flows it generates. So going into the investment, that needs to be your mindset as an investor.
So we talked about a lot of negatives. I want to switch and talk about some of the positives, because the private credit market and private markets in general continue to expand to become more important, not just to investors, but the financial system. And I want to talk about, some of the growth areas and what your thoughts are and what excites you the most.
Sure. You mentioned financial systems, so that's important to hit at. Like, why does private credit exist? And the growth we've seen really post-financial crisis, as private credit is now a third leg of the stool alongside public markets and bank balance sheets. So the system is stronger, more diversified for that. Borrowers are better off. They have more solutions, and end investors are better off. They're able to benefit from the premium associated with private credit.
Going back to your days of Treasury, when you saw the markets, the public markets and the banking system having more regulation, now, 10, 15 years later, we've seen this massive growth of private markets. You mentioned that it's really the third leg of the stool in terms of financing the global economy. Do you think that there's policy on the way, or do you think policymakers are starting to think about regulation around private markets?
They are. I'm expecting more, not less. Now, look, if you look at the private credit industry, and let's just look at it from a data and transparency perspective. Some of that is by design, right? You're lending to a private company. That company is wanting to execute in the private markets for speed, certainty, confidentiality, to work with one lender as opposed to a large group of lenders, right? So the transparency or the less transparency, like that is by design, the private nature. There are also elements of private credit that probably need more transparency and more consistency, if it's more consistency on the valuation and reporting side, as an example.
Amazing. Interesting. So it remains to be seen in terms of the scope and speed, but your expectations is that as this market evolves naturally, regulators will get more and more involved.
I would expect more involvement, and I don't necessarily think that that's a bad thing for managers and for the industry as a whole.
Amazing. What's a lesson you learned the hard way in private markets that still shapes how you think about investing today?
Yeah. So I would say three lessons, right? One, we spoke about earlier, which gets to risk, and risk being more than meets the eye from an asset perspective. It's the liability side. how your funds are structured. If you're using leverage, is that leverage match? So it's the asset and liability risk would be one. Two would be just diversification. So, managing risk is largely probabilistic, right? We don't know for certain what's going to happen. We try to have a base case, a downside case. We stress investments. The one risk you have full control over is your ability to diversify, right? And so that is something relating to if it's position sizing, if it's diversification across sectors, if it's diversification in asset-based finance as an example, where many of the borrowers are small, they're granular positions. So there's a lot of ways to achieve diversification in a private credit strategy, but it's one risk mitigation tool that you have 100% control over. So you want to keep that front of mind. The third would be on feedback, right? Feedback is a gift. Especially when it stings, right? That applies to both personal feedback, right? Professional feedback, as well as feedback on investments. So when deals go wrong, they invariably do. We've all made mistakes, stepping back and learning from them. What went wrong? Why? What could I have controlled? What could I not have controlled? And what do I want to do differently going forward? So really being kind of introspective and learning from mistakes would be the third.
There were one takeaway that you'd want for someone listening to have from this conversation, what would that be?
From a private credit perspective, if you're an advisor today, stick with it. The asset class has the potential to create real value for your clients if sized appropriately. Be very focused on the education. I think that's important.
Well, Matt, thank you so much for joining today. It's been an absolute pleasure talking to you about the private markets and your experience. And I just want to thank you for joining us on the podcast today.
Thanks, Brian. Thanks for having me.
Thank you for listening to today's episode. Please rate, review, and subscribe on your favorite podcast platform. I'm Brian Resnick, and you've been listening to Uncommon Capital.